Everyone, welcome to my channel. I'm Doris and I'm here to share with you about today's market. Today, US stocks closed higher for a second straight day, with the S&P 500 hitting a new 3-week high. Can the banking crisis be resolved? Blackstone is confident that most American banks can withstand the turmoil. Let's take a look at the market today. All of the market indexes closed higher. Dow Jones Industrial Average closed 0.43% higher to $32,859.03. At Nasdaq closed with a gain of 0.73% to $12,013.47. And the S&P 500 closed with a gain of 0.57% to 4,050.83 points. All of the industries closed higher except for the financial industries and internet content and biotech. The internet retail closed highest with a gain of 2.38%, and the semiconductor also closed with a gain of above 2%. Markets think that the regional banking crisis is over. Boston Fed President John Collins said the Fed needs to raise interest rates further to curb inflation. Chicago Board Options Exchange Volatility Index (VIX), the S&P 500's preferred index for the next 30 days, has fallen back to 19 points. In mid-March, the VIX index, also known as the Fear Index, hit 30 points at the height of the banking crisis. Barclays analyst Ajay, said in a note on Thursday, overall financial market pricing reflects expectations of both recession is low and significantly lower than inflation, but will not have a significant negative impact on corporate earnings. The yield on the 10-year Treasury note rose to 3.594% after data showing U.S. jobless claims rose for the first time in 3 weeks. Bank stocks in regions such as Western Alliance and the Pacific West are generally higher, with investors believing that the Fed has contained the banking crisis and stopped it from spreading. The Biden administration called on Thursday on regulators to tighten regulations on mid-sized banks in response to the banking crisis that had failed several banks. The White House on Thursday called on federal banking regulators to work with the Treasury Department to implement a series of changes to tighten the rules. In a statement, the White House said the measures do not require congressional approval. The proposed changes include the resumption of regulations on banks with assets between $100 billion and $250 billion, like the Silicon Valley banks, such as liquidity rules, stricter stress tests, and so-called living wills. Global Investment Senior Portfolio Manager Thomas Martins said the U.S. stock market this week was affected by a number of factors, including the latest corporate earnings reports, speculation about future interest rate paths, and the possibility of a U.S. recession, and the latest states of the banking sector. The stock market naturally fluctuates, but it has never been so dramatic. Investors have too many factors to consider. Schwarzman believes that mobile apps allow people to communicate quickly and transfer money, coupled with the sharp increase in savings after the outbreak, has led to the current turmoil. Moody's, the rating agency's firm, expects the risk to sovereign credit until pressure intensifies. Moody's said, over the past week, the operating environment of our regional U.S. banks has deteriorated rapidly, indicating that the banking crises are higher than we previously considered in our sovereign credit status. Barclays strategist Joseph Abate believes in the U.S. banking crisis. U.S. banking system could be heading for another wave of deposits as clients realize that money market funds offer higher rates. On the economic data front on Thursday, the Labor Department reported that the initial claim for unemployment benefits in the week ended March 25th were 198,000, compared with 196,000 expected and 191,000 previously. According to the Commerce Department's Bureau of Economic Analysis, the final annualized real GDP was 2.6%, slightly lower than expectations, and 2.7% previously. The report also shows that the U.S. Core PCE price index rose 4.4% in the fourth quarter year-on-year, compared with 4.3% expected and 4.3% last month. Real personal consumption spending rose 1% in the fourth quarter from a year earlier, compared with 1.4% expected and 1.4% last. In addition, Boston Fed President Collins, Richmond Fed President Barkin, and Minneapolis Fed President Kashkari all spoke on Thursday. Boston Fed President John Collins said the Fed needs to raise interest rates further to curb inflation. Inflation is still too high, and the recent indicators reinforce my view that we have more to do to keep inflation in line with the 2% target, she said. Richmond Fed President James Barkin said the effect of the rate hike was a lag. There is no view on whether a rate hike is appropriate at the next meeting. It is hard to imagine inflation falling without any lower demand. According to CE's Fed's observation tool, the market sees the Fed holding current rates at 58.8% in May. Can the banking crisis be solved? Blackstone is confident that most American banks can withstand the turmoil. The rapid collapse of SVB and two other regional banks have added to fears that other banks could have also collapsed on a bank run. But Steve Schwarzman, CEO and co-founder of global private equity giant Blackstone Group, is optimistic that U.S. banking crisis could be largely resolved. He expects that most U.S. banks to be able to withstand the current industry turmoil. He blamed the current banking turmoil on the pandemic and technological advances, rather than on the wave of bad loans. The banking system is not caught in a traditional crisis. The banking system is not caught up in a traditional crisis of any kind, he said in a media interview on Thursday. All we face is temporary problems from rising interest rates and deposits from technology upgrades. For most banks, both problems can be solved. Schwarzman said mobile apps allow people to communicate quickly and transfer money, coupled with large increase in savings after the pandemic, has led to the current turmoil. The crisis was caused by people using iPhone and other devices hearing on social media that some banks could be in trouble. Schwarzman said the response was large withdrawals in a very short period of time, which causes the bank to fail. Other people in the industry, including Citigroup CEO Jim Fraser, have also pointed to the role of mobile banking, where depositors can transfer millions of money with just a few clicks of buttons. Asset management giant Pioneer Pilot Group, Vanguard, the head of fixed income department of the Sierra Nevada, in a recent interview pointed out that current banking crisis is more like an emotional contagion, rather than we see the global financial crisis at real systemic risk. Due to the rapid action of federal agencies and other banks, risk has been basically under control. Non-bank financial institutions have no risk. Schwarzman also noted that the difference between banks and financial companies without deposit business. It is important to understand that for deposits, the risk is actually limited to the banking system and has little to do with other types of financial institutions because they don't need to give money to people immediately. Blackstone's real estate investment fund has also faced pressure from investors to withdraw money. In response, Schwarzman said the group's real estate investment was in good shape, noting that it had cut investment in office building, while other markets such as warehouses were still doing well. On the economic outlook, Schwarzman believes the economy is slowing, which will put more pressure on asset valuations. He said it was logical for the Fed to raise rates. That could provide a buying opportunity for Blackstone, which had $187 billion at the end of 2022. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.